There's a piece of plastic in almost every wallet in America that was never actually supposed to make money from purchases. It was supposed to make money from you not paying. That's how much credit card debt Americans are currently carrying, more than the GDP of most countries on Earth. And the story of how we got here starts with one man, stuck in a restaurant without his wallet. Chapter 1. The Forgotten Wallet. In 1949, a businessman named Frank McNamara took some clients out to dinner in New York. When the bill came, he reached for his wallet and realized he'd left it at home. He was mortified. His wife had to rush over and pay the bill in person. Frank swore he'd never be caught in that position again. So he did something nobody had really done before. Along with a business partner, he created a small cardboard card that let members charge meals at a handful of restaurants and settle the bill once a month. He called it Diners Club. It sounds simple now, almost quaint. But at the time, this idea was genuinely radical. Spending money you didn't currently have, based purely on trust and a promise to pay later. Within a year, Diners Club had 20,000 members. Restaurants signed on because the card brought in customers who spent more freely than they would with cash in hand. And Frank had accidentally built something much bigger than a solution to an embarrassing dinner. However, Frank's card only worked in one narrow use case: restaurants, and only ones that had agreed to accept it. For this idea to become a real industry, someone needed to think much bigger, and the banks were watching. Chapter 2. The Banks Move. Banks realized this charge now, pay later model didn't need to stop at restaurants. It could work for literally anything: groceries, clothes, gas, furniture, appliances. In 1958, Bank of America launched the first true general-purpose credit card, called Bank AmeriCard. Their launch strategy was almost unbelievable by today's standards. They mailed out 60,000 unsolicited cards to residents of Fresno, California, fully activated, no application required, no credit check. It was reckless, and it nearly ended the entire industry before it began. Fraud was rampant. Cards were stolen straight out of mailboxes. Some recipients ran up massive bills and simply never paid. Losses piled up so fast that Bank of America nearly shut the whole program down within its first year. But buried inside that mess was a discovery that would define the entire industry going forward. The customers who carried a balance month to month, rather than paying it off in full, were dramatically more profitable than the ones who paid on time. However, to turn that discovery into a real business, banks needed a way to standardize the system across the whole country. And that meant getting banks that were normally rivals to cooperate with each other. Kelly, Chapter 3. Building the Network. A single bank issuing cards only worked if merchants across the entire country would accept it. So through the 1960s and 70s, Bank AmeriCard evolved into a shared network that other banks could license and issue under their own name. This eventually became Visa. Around the same time, a group of competing California banks who'd been locked out of the Bank AmeriCard network formed their own alternative. That became MasterCard. This is the point where credit cards stopped being a product from a single company and became something closer to financial infrastructure, a shared system that any bank could plug into and any merchant could accept, no matter which bank had issued the card in someone's wallet. This mattered enormously because it meant the convenience of just tap and go could scale to literally anywhere. And the more frictionless spending became, the more people spent, which is precisely what the banks wanted. However, there was still a missing piece. Interest rates on lending had been capped by state usury laws for decades, which limited how aggressively banks could actually profit from carried balances. That was about to change in a way that would reshape the entire industry. Chapter 4. The Loophole That Changed Everything. In 1978, a Supreme Court case called Marquette National Bank versus First of Omaha Service Corporation changed the rules of the game. The ruling allowed banks to charge the interest rate allowed in the state where the bank was headquartered, not the state where the customer lived. This might sound like a small technicality. It wasn't. States like South Dakota and Delaware rushed to eliminate their interest rate caps entirely, specifically to attract credit card companies to set up headquarters there. Within a few years, major banks relocated their card operations to these states, and interest rates on credit cards, which had once been capped around 12 to 18% nationally, were free to climb far higher with far fewer restrictions. This single ruling is arguably the moment credit cards transformed from a convenient payment tool into one of the most profitable lending products in modern banking. However, charging higher interest was only half the equation. The other half was making sure people didn't pay their balance off, and that required understanding something about human psychology that banks were only beginning to exploit. Chapter 5: The Minimum Payment Trap. Here's the part almost nobody fully understands about how credit cards actually generate their profit. An 18% annual interest rate sounds moderate on paper, but when it compounds monthly against a balance where you're only paying the legally required minimum, the math works dramatically against you. A $5,000 balance paying only the minimum required amount at an average interest rate can take over 2 decades to fully pay off and end up costing more than double the original amount by the time it's gone. This isn't an accident or a flaw in the system. It's the business model. Credit card companies make the vast majority of their profit not from the small fee merchants pay when you swipe, but from customers who carry a balance and pay interest on it month after month. Minimum payments were deliberately set low enough that they feel manageable, while barely denting the actual principal, which keeps the interest clock running as long as possible. However, this created a real problem for the industry over time. What happens once enough people start figuring out how the math actually works against them? Chapter 6: The psychology of plastic. Researchers studying consumer behavior found something counterintuitive. People consistently spend more when paying by card than when paying with physical cash because the psychological discomfort of spending is dulled when money isn't visibly leaving your hand. Credit card companies have understood this for decades, and it's shaped how the entire industry markets itself. It's why rewards programs, cashback offers, and travel points exist. They don't just reward spending, they actively encourage more of it, often outweighing what the rewards are actually worth for anyone who ends up carrying a balance because of it. Some card companies have even been found to design their statements and mobile apps in ways that make the minimum payment prominent and easy to select, while the full balance and true cost of carrying debt are less visually emphasized. However, not everyone falls into this trap. And the difference between the people who use credit cards profitably and the people who get buried by them isn't income level. It comes down to a small number of habits most of us were simply never taught in school. Chapter 7: The 2008 Reckoning. By the early 2000s, credit had become deeply woven into how Americans lived. Not just credit cards, but mortgages, auto loans, and lines of credit extended to people who, in hindsight, banks probably shouldn't have been lending to. When the 2008 financial crisis hit, credit card debt became one of the many casualties. Unemployment spiked, and millions of Americans who'd been managing their balances suddenly couldn't keep up. Default rates soared. The backlash led to real regulatory change. In 2009, the Card Act was signed into law, one of the most significant pieces of consumer protection legislation in the industry's history. It required companies to show customers exactly how long it would take to pay off their balance at the minimum payment, restricted how interest rate increases could be applied retroactively, and limited aggressive marketing to college students who often had no independent income. For the first time, transparency became a legal requirement rather than a courtesy. However, transparency alone doesn't change behavior. It just gives people the information. What actually determines whether someone wins or loses with credit cards comes down to a handful of practical rules. Chapter 8: Playing the System. Instead of losing to it, used correctly, credit cards genuinely aren't dangerous. They can build your credit history, offer fraud protection cash simply can't, and yes, provide real rewards and cashback. The entire risk comes down to one habit: paying the full statement balance every single month without exception. Do that consistently, and you access nearly all the benefits of the system with none of the interest cost. Miss it even once, and the math flips against you fast, and can take months or years to fully recover from. A few practical habits make this dramatically easier to maintain. Treating your credit limit as if it doesn't exist rather than as spending power. Setting up automatic full balance payments so you're never relying on memory, and checking your statement weekly instead of once a month so nothing sneaks up on you. This is really the whole story of credit cards in one sentence, a tool built over 70 years to profit from a habit most people were never taught how to avoid, and one that becomes almost entirely free once you understand exactly how it works. So the next time you tap that little piece of plastic, remember, it was never really about convenience. It started with one embarrassed man at a dinner table in 1949 and turned into a trillion-dollar industry built on the gap between what people earn and what they're willing to spend on a promise to pay later. If you want to make sure you're using credit the smart way instead of the expensive way, I will make a video breaking down exactly how I built my own credit score from scratch as a complete beginner. Turn on the notification bell and subscribe to this channel so you can get access to the video when it's being uploaded.